Hello, everyone, and good afternoon, or wherever the time may be where you are when you're listening. Sorry, I just got a little surprised for a moment. It's the first time I've looked at myself for a bit. That being said, welcome to this month's webinar. For those of you who don't know me, my name is Kristina Kuprina, and I'm the founder and chief economist at Sequoia Wealth Advisors. And we do these webinars about once a month, just basically to give an easy to understand, quick update on the economy, what's going on, answer all the questions, and boy, do we get a lot. I'm not sure if this is the record number of questions that came in advance, but we have a lot of questions today, so I tried to incorporate as many as possible into the talk. However, I cannot stress enough, please put your questions in early because I want to cover all of them today in the time we have together. So that being said, really quick one. This one is sort of an economic outlook or update as we approach the end of the year, and also kind of a little bit separating what's behind the headlines. Because some of the most common questions that I get are questions of things that people heard in the news, or the media, social media, traditional media, etc., and what it means, or is it true, and how does that potentially impact them or those they care for. And oftentimes, what we see in the media is opinions disguised as news, possibilities, if this happens, or what if, or this might happen. Or obviously, as everyone well knows now, there's a lot of political bias as well, or social bias and things like that. And so that being said, navigating it is always an interesting challenge. As I mentioned before, I get my economic data from excellent sources with high accuracy rates. Costs a lot of money, but it's well worth it. But I do check in on the regular news channels each day, each morning online to see kind of what everyone else is seeing in the world. And there's oftentimes just a big discrepancy between the two. Short-term news being seen as a long-term effect, stories that may or may not be relevant to the economy that are kind of tied into it, again, for political expediency. And so I kind of framed a lot of these questions in sometimes what you hear on the news and sort of what's happening behind the scenes. I'm going to put one big caveat on all of this. People see the world in many, many different ways. So, and nothing I'm saying today is intended to change anyone's mind, change anyone's values or beliefs. It's simply kind of going into the economics a little bit and sort of showing sort of what's happening behind the scenes. So I want to bring that up right away because as much as I'm not my favorite subject, politics and economics do intertwine right now. Probably always do. So that being said, as I said, send in your questions. We have a lot of registrants this time. And as you know, the post-pandemic world, a lot of people listen to this recording later. So I really appreciate those of you who are doing that sent them in advance. Again, I kind of tied them all together. So without further ado, I'm going to start with the topics that I'm hearing the most from you, dear clients, as well as other people that I advise or I speak to. And the reason for that is that's usually something that's on a lot of people's minds, and you may or may not have brought it up or even thought about it. But that being said, like I said, if any of this opens new questions, please send them in. So some of the biggest questions I've had right now has been, with everything happening in the world, everything happening in the news and in politics and geopolitics and domestic politics, why is the markets doing so well? Why are the markets doing so well? It's kind of a high question. I'm going to talk quite a bit about that and explain the whys behind it. And I'm also going to kind of go over what is really positive that's happening right now economically, and also where some potential concerns are. Okay, and how why those concerns aren't being reflected in stock prices right now. So that being said, I'm going to kind of start with that and kind of tying it into many of your questions, and then towards the end I'll jump into the direct Q&A. With that being said, so the news is oftentimes designed to get everybody really excited, to gather attention, to grab attention in the headlines. And we do have a lot going on right now. And if you haven't noticed, you know, we got a government shutdown. We got a lot of geopolitical events. Some of them are, you know, the usual conflicts and things like that. Also, we have, you know, trade and tariffs, and we had some big developments there last week. So there's a lot of things happening. And some of them have economic effects directly, and other ones have potential economic effects, and some of them really are none at all. It's more political / again social. So the big one right now, it's not in any order of priority. It's just the big one that's catching a lot of people's attention is the government shutdown. So just a little bit of history on that. Again, try not to drag you into what you already know. Uh, this used to be something that Congress would never let happen. It's like, we can't shut the government down. We have got to figure it out. I don't care how much we disagree. We can't let this happen. And in recent years, that's actually changed. Political expediency and, for lack of a better term, winning has become more important than keeping the government running. And so the question also comes out, whose fault is it? Whose fault is it? And the answer to that oftentimes may depend on your political views, because it's easy to find fault with either side. But generally, kind of the order it has been in recent years has been the party not in power uses that as an opportunity to try to get their agenda done or specific things that are important to them. Sometimes it's not even things that are important to them, it's things that will just stymie the other side. So it becomes more of like a political gamemanship. And why? When the party's not in power, and again, both sides have been on this side during these government shutdowns. When the party's not in power, they really want to show their supporters, hey, they're doing something, they're fighting for their causes, and also too to try to get things done, because they don't have an easy opportunity when you have presidents doing executive orders. Again, both sides do this, and also Congress being more one-sided depending on the results of the election. So this oftentimes happens in that gap between midterms when there's sometimes more party control on one side. So this time around, again, not picking on a side, because they've both done it. This time around, the Democrats are not in power. And so this has been their opportunity to say, we are going to push for things that we want to get done. And it's been publicly stated by them, so this is, not hearsay. They really, really want to get at Trump. And this is the way of doing it when he's got his party largely tied with his agenda. And this is the opportunity to get things done. Some of the target areas, there's a lot of things that the Democrats want. They have a whole laundry list, including repealing parts of the OBBBA Act and other things. But the big one that gets a lot of attention is healthcare. During the pandemic, there was an extraordinary expansion of healthcare and government, tax credits and expansion of the healthcare system, what the government's paying for in the healthcare system. And this was done at the time with the intention of making sure that everyone got access to healthcare during a time when, jobs weren't necessarily there, right? Healthcare wasn't as stable and as certain, so there was more of a government. And it was done through tax credits and through government subsidies and expansion of the healthcare system. People that was accessible to Obamacare or the Affordable Care Act, as well as through the various state programs and Medicaid/Medi-Cal. So this being said, that expansion obviously has a big cost, and it was supposed to be temporary. So it was designed, when it was put in place under the Biden administration, it was designed to expire at the end of 2025 with the idea that this was a temporary thing. Many of you may have heard this saying that there's nothing more permanent than a temporary government program, and that's what we're running into right now. Interestingly, this is something that there's some bipartisanship on. They were actually talking about this in Congress, the moderates on both parties were trying to find a solution for this because they knew it was going to be an issue at the end of this year for a lot of people. So it was already being talked about, again, with the moderates, didn't get into a big policy before the government shutdown. So this is an area that may well be what pulls us out of this, is going to be some form of compromise. However, the longer this goes on, the harder it is to find compromise. Ultimately, I cannot tell you how this will end. We're heading into week 3 pretty soon here. Generally, how these things end is pressure from the voters or pressure from the politicians because their people are being directly impacted from it. So early in a government shutdown, people aren't getting paid, but they're going to get paid, right? The back wages and things like that. Government is paying money, but it's going to come out when this gets solved. But over time, it becomes more and more pressure. And in past times, it's been pushbacks from government workers not wanting to come in to work, or people feeling that they weren't getting the right levels of service. And then again, it comes from the voters pushing their politicians, get a deal done. This is impacting me. I'm being very simplistic about that. There's a lot that goes into it, but I'm trying to keep that part high level. So economically, like I said, these things happen often enough. When they first started happening, the market freaked out because it was a big deal. Now the market's like, whatever, they'll figure it out. To this point, right? If it goes on a long period of time, the economic effects start to cascade and it can become more of an issue. And that could be the other potential pressure point to get it resolved. So highest probability this will be resolved in the not too distant future, but there's no certainty there. And if it goes on for a long extended period of time, you can see some short-term volatility and reaction to the markets as it starts impacting the economy directly. So I was kind of like a high level on the government shutdown. Hopefully that helps. A little prong to that little thing is that we as economists have to work harder now to get some of our economic data because we're not getting the regular reports like unemployment reports and whatnot from the Bureau of Labor Statistics. Good news, those of us that do this work, we actually know how to calculate it because we know their formulas, so we can pretty much pull together what's happening based on data that's widely available and just using their same format to get it. They did say they will release the inflation data will be released just a little late, I think on the 24th of this month. So that's the only report that we're going to get directly from the government. Everything else until the shutdown ends is going to be our own calculations. So be wary of that. It's really important if someone says, that's what the report would say, make sure they're actually doing their homework and they're not just guessing or again, have an agenda with it. So high level government shutdown. I already see a bunch of questions, so I'm going to just touch on the two other things and I'm going to just hop into questions really quick. Let's see. The other one is, are we in an AI bubble? Okay. The markets have run up quite a bit. Okay. And I'm going to talk more about the markets later. But there's a talk, of course, is this a bubble, right? AI, is this like .com again? Is this all going to crash and burn? That's been a really big thing. And the answer to that is actually a little nuanced because let's just make it really simplistic and say there's three areas, two primary and one secondary areas. There's more, keeping it simple here. So the primary thing is, are the companies that are in this area, this industry for lack of a better term, or in the aerospace, are they actually making money? Okay, or is it a speculative bubble? Good news is we can actually tell because we have this wonderful thing once a quarter called earnings season. We have just entered earnings season now for the third quarter. I love it. It's like Christmas for me 4 times a year because I get to unwrap the presents and see, is the company fairly valued? Are they likely going to be higher valuation in the future or lower? So the earnings season, what is great about it is you can't lie on earnings reports. You can't have an agenda. You have to say it as it is. And that tells us, are companies doing well? Is this real investments or is it speculation? So within the area, there are companies that are highly valued right now that I'm not quite sure they're ready for that. And I think there's a high probability that you're going to see some pullback with those companies in technologies that are up and coming and will likely be successful in the future, but they're not quite there yet, just because there's so much money and a lot of money's flowing into the markets in this space. So kind of a mixed bag. Companies doing well. They really aren't making money. AI investment is real. We saw that in last quarter's earnings. Companies are putting a lot of money into it. And I'll explain again why later on when we get to inflation. But that being said, it's not a bubble like a .com bubble because there's money being earned, but there are companies that are probably valuations are a bit high right now. Also, anytime the markets run up as much as they have in the relatively short period since the drop around the tariff announcement in April, markets need to take a breather. It is healthy. You guys have seen the charts, right? Up, pull back, up higher, pull back, historical charts. We need those pullbacks. We need this sell off because that releases some of the pressure and it brings the buyers in and it becomes a more stable long-term market. So that being said, a pullback is not a concern because the underlying economic data does not show a recession, at least out into next summer. We can see that clearly enough. Highly likely at this point, based on long-term data, that we won't see one until next decade. So in the 2030s, 2029, 2030 space doesn't appear. We can see pretty darn clearly the next few months, barring a COVID-like shock, because those we can't see, we're unlikely to be in a recession. So that being said, the markets, though, are being driven by a few companies in this space more than what we're seeing with other companies. So we had some positive news. We got a lot of financial companies released today. They're doing pretty well. Again, just the beginning. It's not a representation of the total earnings season, but we want to see not just this sector or this space. We would like to see other companies starting to benefit from their investments and benefiting from the economy overall. I'll get into the challenges here in just a moment with the economy, but just they're saying, hopefully that answers the AI bubble question because that one's come up a lot. Let me answer the two. Okay, let me answer some of the first questions that came in. There's a lot of them, and then I'm going to get into what's doing well in the economy, and then where the risks are. I'm going to talk about that next. So let's see. So I have to lean over. even with glasses, stop leaning over. Can AI affect the real estate market value in 2026? I'm going to hold that question because I'm going to talk about real estate because there's some interesting things happening there. But I'll get the answer to that. I'm growing more concerned about the potential for a CDC collapse that impacts to our cities and country, leading to additional negative economic impacts locally. Should I be considering more tangible investment assets like gold? I'm just going to confirm. Sorry if you're listening to type this in. I just want to confirm. You mean CDC, Centers for Disease Control? Because that's how I read that. And I just want to make sure. So there's a lot going on there. There's not from an economic standpoint, I understand from a social standpoint and from a healthcare standpoint, there can be concerns there. Economically, the concern is actually a little bit the other direction because there are two things happening in the space that impacts the pharmaceutical industry. One is the current, I don't call it administration, but the current group running that show is in favor of wholesale vaccinations and wholesale, drug use. Sorry, prescription drug use. Want to stress that one. They have a little bit different philosophy towards it. So not giving the guidance, everybody should do this, everybody should do that, could have an impact on the pharmaceutical companies. Another one is something that, hey, I could use the word bipartisan. Biden administration did it, Trump administration continued it, is trying to find ways to reduce the cost of drugs to the consumers, especially widely used drugs like insulin and whatnot. The challenge to that is that they'll get those drug costs, the drug companies reduce those drug costs, then what happens is they raise the cost on other drugs, right? So, they still need to make money, they still need to, do the research and things like that. I know it's a sensitive topic, lot to be talked about there with healthcare. But that being said, from an economic perspective, that is not an immediate concern. Something to watch, certainly, but not an immediate concern from that. To answer the second part of your question about investing in gold or other types of assets, it depends what your objective is and what your needs are and where your other resources are. Okay, so I will talk a little bit about that because that question comes up a lot. Where do I put my money if I think everything's going to collapse or I have concerns about the economy? It's a very individualized answer. It's not a one size fits all, and you want to understand how to do it and the considerations. So this question, I cannot stress enough, talk to someone, and I'm not saying it should be me. I'm not here to solicit. You have to talk to me. I'll be happy to answer the questions because I'm kind of a geek, but talk to someone who's not out telling you something, doesn't have an agenda or an opinion, and is just going to be able to very calmly tell you, here's the pros and cons based on your situation. Because sometimes what I see that is people take so much of their resources and put it into something. And this happened after the financial crisis. There was a big rush, gold prices were rising, financial, collapse, financial crisis, gold price. And then people thought, oh, the system's going to go down. And they took so much money, they put it in gold. Well, gold is very volatile. And as the economy started to recover, the price of gold crashed and they were stuck, right? They're just now seeing that money come back to them if they helped for that period of time. So it's really important, like any investment or financial decision, it's really important to see the whole picture, to understand the entirety on your specific situation, not just the overall economic perspective. Everything I'm sharing with you is informational, it's not advice. Regulators make me say that, and quite frankly, it's true, not knowing your specific situations. I answer that, but please correct me if you didn't mean Center of Disease Control, because I just want to be sure I have that right. Okay, that being said, I'm going to go into the pluses and minuses. So what's the positives that's driving the economy right now? Okay, number one, massive investment in the AI space. It is, for lack of a better term, an arms race. It is, I hate to use the example of nuclear weapons, but in a sense, whoever gets this faster is going to be the winner of the world. Exaggeration to some degree, but not really. The speed of this technological advancement is happening so quickly, and that's going to get a little bit kind of what China's doing right now. They want to win this race. So technological advancement is happening so quickly, and it is so critical that the leader in this space is going to literally be the leader in many aspects in geopolitics as well as their domestic economies. So there's this big push, and there's also a race too. Like you've got some chip companies that are producing the chips needed right now, and they're on the forefront, and they're working with other, and they're just basically, even funding data centers, right, to help speed this along. You have a lot of this, not just I'm building the chips and everybody buys the chips and then they do their own things and somebody else builds the data centers. You're seeing this investment of companies in different areas in the AI. I'm using AI as a general term here, all types of this technological advancement that we have, not just generative AI. That being said, they're investing in this because they want to help facilitate. Yes, of course, it helps them, but they also want to help facilitate the advancement. So you're seeing this massive investment. You're seeing it in companies outside of what you call your tech companies because they're investing because of the inflation aspect. So inflation isn't going anywhere. I'll throw that in there now. It's largely caused by how much money we've pumped in the system, especially during the pandemic period. The money didn't disappear, and that is keeping, and just basics of this, is keeping costs high. There is nothing the president can do about it. Not a Democrat, not a Republican, not a congressperson. It is not something to be solved this way. The only real solution for it is we produce so many goods and services that the economy is flooded and the prices drop on their own. That's not going to happen. No company is going to purposely destroy itself, right? The second element would be a recession or a significant economic downturn. It doesn't have to be a full recession. That will bring prices down. None of that's in the cards for the foreseeable future. So prices are going to stay high. Right now, inflation, again, we'll see in a couple weeks, in a week or so, the next report. But we're sitting around 2.7. Next year, we'll probably hit 4. That'll be our high point. Then we'll start to drop again. Okay. What does that mean? We're not at the 9% that we were in 2022. So we're not going to have this out of control, crazy inflation, but prices are going to be higher. It's going to curtail the Fed's ability to do significant rate cuts in the future. And it's going to keep costs higher. So what are companies trying to figure out? How do we create efficiency? How do we create productivity so we don't have to raise our prices? Any technology that helps that is going to be beneficial. And that's why you're seeing a lot of investments taking place in almost every company and almost every sector. You're seeing some form of this being used to create productivity of their employees. That's also why employment is not growing as quickly, right? We're not seeing these big layoffs and cuts, but we're also not seeing this big hiring, even though companies are growing and their earnings are growing. You're not seeing as much hiring because they're looking for productivity within. So far, it hasn't been too much of an issue because we don't have as many people in the labor force for a lot of reasons, basically demographic. But that has not pushed this, like all these people being laid off, at least to date. But that investment there again is pushing along the AI. So the AI investment is real. There are challenges to it. You're seeing pushback from areas that don't want the data centers because of its power use or its water and energy use or just how they want to build. It's going to be the area that allows this to happen is going to grow the fastest. The areas that restrict it could grow slower. There's going to be this very rapid changes, which will create. I coined a word for it. It was disruptive abundance, and I'm going to have a whole webinar on disruptive abundance and what that means. So AI spending, investing, a big one. Consumer spending. Despite everything happening, consumers are spending, and they keep going, and they're spending a lot. Primarily people in the top 3 quartiles. So you just imagine 5 groups of people, 0 to 20, 20 to 40, 40 to 60, and then the top 20, right? In income and earnings. So from the 40% to up are spending like crazy. The lower quartile is spending less. So they are being more cautious because they're being more pressured by rising costs, and they don't have the rising wages necessarily or the rising, asset appreciation. But we're just not seeing the bulk of the consumers, the middle class and the higher net worth are spending. And again, not getting into the social aspects of that, getting into the economic aspects. That's a driver of GDP. That's a driver of our economy. Consumer is 2/3 of it. And the consumer has not slowed down despite the challenges, with, again, tariffs, inflation, and things like that. We're also seeing just overall, just higher valuations. Companies are guiding higher, and that's a positive in general. They generally won't do it unless they feel pretty confident that they're going to be hitting it. I mentioned rising wages. So I mentioned inflation around 2.7, official number. Wages are 4% year over year. So we're seeing wages are rising much faster than inflation so far. That again gives people the means to be able to continue to spend. Most of our metrics for tracking economic growth are trending upward. Most, all of them are. And that's, again, another positive sign. They're trending upward despite what's happening. Alrighty, here's the, I call it the potential minuses. China's ramping up the trade war. Okay, China's doing it for a number of reasons. Number one, the biggest one is their economy is in serious trouble, and the government needs to grow at a certain rate to prevent social unrest. So they have got to do this. They don't have many options. They've got to stimulate their economy. So stimulating their economy is trying to put a lot of curtailing imports so that there will be more domestic consumption. That is a big push of theirs. And so this is not a reaction to Trump's tariffs. It's more of an, hey, this is what we need to do. We need to curtail imports so that we can use more domestic consumption, create more jobs. They have a massive unemployment rate in their young population, their younger population. It's a big, big issue. So they're really trying to stimulate their economy. Another one, I mentioned the, I guess the tech war, probably our term. Everyone trying to get up there to get AI faster, faster, better, better. Who's going to win? Who's going to have the best chips? Coming down the road here a little bit, quantum chips, which will be the game changer for everything. There's just this big technological arms race, and they really want to win it. So that's another reason. Final one is a little bit of Trump-like behavior in, hey, we're going to put all these things on you, and then we're going to negotiate our way out of them. So it's a little bit of that. So last week, China started just putting all these curtail. They control 70% of the rare earth minerals that are needed for a lot of our technology. At a time when us in the US were very focused on green energy and not using fossil fuels or not using, mining operations and things like that. China did the opposite. They own a lot of mines, a lot of these resources in South America and in other parts of the world. So they currently control about 70% of the rare earth minerals. And so they're trying to put curtail that again, less, ability for the competition to get a hold of them. And a number of other things they're trying to do, as well as other, especially US-based chip makers, restricting them. They went after Qualcomm last week with an antitrust suit, said because they bought a company in Israel, they did something wrong. And so it's this constantly stymieing of competition from overseas. Fortunately, we hear all the time how much stuff we get from China. That's actually not true anymore. It hasn't been true for a while. There can be some disruption, but we've had challenges with China for a while, so that you've seen a lot more of that factory type work and manufacturing going to other countries, say Vietnam. So it's not as much of an issue for us. However, it's still, if we're going to have this competition, and they still do purchase from us, we can see this trade war accelerating, and that could potentially create some challenges, at least in the short term, until we can work out other suppliers for these types of things. Other risk, the government shutdown goes on too long. I think I mentioned that earlier. We don't know what too long is, so it doesn't really matter if you say, oh, it's almost the longest one. If it goes on another week or so, it's going to be the longest one. But we don't actually know because we've never gotten there. So we just don't know. And a lot of it will also depend on what else is happening. Is the government kind of finding ways to fund certain operations? We're hearing about that now with funding parts of the military, right? Military pay. Can they find ways around to sort of support things until it gets done? So unknown, but certainly the longer it goes on, the risk does increase. I mentioned hiring. So we're not hiring as many people. It's not needed right now because while we're growing, we're not growing at a point that companies can't innovate and can't balance it out. So we're still hiring, but we're not hiring at the same rates that we were previously. Does that decline further? Does that become a concern? I mentioned inflation as well. The other thing is inflation will rise next year and it'll peak next year around 4-ish. And that's going to get a lot of headline. This will be a lot of headline, right? For political expediency, just for, inflation. Though for those of you collecting Social Security, you'll appreciate the COLA increases, or pensions will appreciate the COLA increases. But then again, so is the costs of things rising. So that was kind of like a high level talk about, that as far as the pluses and minuses of the economy, kind of getting those questions. So the growth next year is going to be a growth year. It's looking actually pretty good. Doesn't mean we're not going to have market volatility. It doesn't mean that we're not going to have surprises, but collectively in the year, I'm not explaining, it's not going to be this explosive growth. We're not going to have this when we had ultra low interest rates and the government was just throwing money into the system. Those very low interest rates that we had since the financial crisis all the way to the pandemic, and then they went lower during the pandemic. That did create some, what I would say, or I don't call it artificial because they really happen. But the standpoint of, real estate was much cheaper. So that drove up a lot of the price increases in real estate. A lot of these things were created with these very low interest rate environments. So interest rates now, while they've come down from their highs, they still do slow down certain parts of the economy. I mean, you probably have seen the impacts on home affordability, people, anyone borrowing on debt or using debt, companies and individuals. And those interest rates are going to stay higher. Again, they may do some more cuts, but it's not going to go anywhere close to where it was even before the pandemic. So the growth is going to be there. We're going to grow, but we're not going to grow like explosive growth at this point. Again, based on current data, subject to change when new data sets come out. So I always say timestamp these webinars because tomorrow's data is different, so it could also change these numbers, but highest probability at this point. Interesting one I want to touch upon a little bit was the tariff thing, because that still bubbles up here and there. Now we're starting to get data. Data's fun. The interesting thing is that what's really shifted is that we used to have, like, let's say the four areas of the world that we export the most to and import the most from. It's kind of been pretty consistent. It's been Canada, Mexico, China, and Europe. EU, let's just call it EU, right? And maybe EU and Britain. So those areas of the world. And what's shifted in recent years, especially since current administration came in, is where we're doing it. So interestingly, as our import and exports with China has been declining significantly, it's been rising more than the decline of China with Europe. Europe is not necessarily by dollars, in some areas by dollars, but they're our biggest trading partner, and they keep buying more from us. And that's going to come into the big question I got a lot about what's happening to our poor farmers, right? You may have heard some of the news about China's not buying soybeans anymore from us. What happens to all these soybean farmers in the Midwest and other parts of the country? But here's a funny thing about that. Soybeans or any other commodity, okay, trades on the exchange, it's a global commodity. It's like oil, right? Soybeans are the same. It's only a question of who's buying them, not are they being purchased. So soybeans are priced based on the demand in relation to the supply. So a weather event or a global conflict in a part of the world can, make prices rise because there's less supply. We saw that with Middle East and grain when the war with Ukraine started, right? With the conflict with Ukraine started with Russia, because they got so much of their grain from Ukraine, and there was huge disruptions in that. So the prices for them skyrocketed, but it didn't really change our world because we're not importing in the US. So there are certain supply disruptions that can happen due to conflicts, due to weather, due to disease, things like that. But overall, commodities are priced and available based on global demand. So what happened is, China's not buying our soybeans, but the soybean farmers are now selling to Europe. Literally, the demand hasn't changed. It's just different. Europe's buying less from South America because China's now buying all South America's soybeans. And so Europe's buying our soybeans. So it's just shifting where people are getting them from rather than shifting. There's no demand. That now, I want to stress that's with our, what I call our commodities. Okay, pretty much non-perishable. We are, if you have a perishable good, if you were growing strawberries and you only sold to China and they said, we don't want strawberries anymore, you're going to have more of a challenge, though generally the buyers are set before the crops are planted with most operations. So hopefully that's a kind of a high level touch upon that, because there are quite a few questions about the soybean farmers, but collectively that's sort of how the markets work. It doesn't mean there can't be an individual situation or a farm that didn't properly plan or prepare, or didn't have a secondary market, or didn't have access. There's certainly going to be, any policy change is going to be disruptive. So I don't want to say everyone is doing the same thing. But hopefully that kind of answered the question. But the interesting thing is that Europe is really becoming our largest trading partner, or largest, or almost largest trading partner. And that shift is happening at the expense primarily of China and a little bit Canada, but primarily China right now. So it's nice to say we can kind of see what are the impacts of a rapidly changing environment. Getting a little prong or caveat to that. A lower court deemed Trump's tariff policy to be invalid. However, they didn't feel they had a really strong case in their rationale, so they punted it to the Supreme Court. or they said it's going to the Supreme Court. So it's going to the Supreme Court. The Supreme Court will rule next month on Trump's tariff policy, whether or not he's able to do it. Regardless of what your politics are here, that has a considerable concern is that we have collected a lot of money in tariffs. That money is currently being used to pay down the debt and offset the costs of the OBBBA Act. So it's being put to good use again, love or hate, it's just the reality of it. If that is invalidated, we would owe all that money back. So that would really spike our debt levels and be really disruptive. So obviously it's up to the Supreme Court, they'll rule one direction or the other, but that could very much change how this goes. It would actually create more disruption because they're almost certainly going to look for other ways to do it, and the uncertainty will all be back again. So we'll have to really watch and see how that ruling goes next month. So yeah, I want to make sure I'm covering the big super questions. I think I touched upon GDP. We'll continue to expand. Let me touch upon housing, and then, oh boy, there's a whole bunch more questions. So let me touch on housing. How it always goes so quickly. So housing, that's one that a lot of people have questions on, and I think because it touches a lot of us, it's more personal than me talking about soybeans. You're like, if you're not a soybean farmer, that's just, fun data. Or at least I think it's fun. But housing is an interesting one because what's happened in housing in recent years has been these ultra low interest rates that we kept for the 12 years between the financial crisis and the pandemic, and then again dropped ultra low during the pandemic, and have only since 2022 went up. So we had about 14 years of really low interest rates that made housing much more affordable, but had the effect of when there's more demand, there's not enough supply, prices rose. So getting a mortgage on, I'm just going to throw out $1 million home at 2 or 3%, as it was during the pandemic for many, is a lot different than getting it at 7%, which it was just before the Fed cut rates recently. So the affordability issues have been exacerbated by these higher interest rates at a time when housing prices have not meaningfully declined. Recently, we have seen a mild, these are national numbers. Realtors will tell you location, location, location. So national numbers, we've seen a mild decline in housing prices. I'm trying to remember my numbers, but let's say the median home price was like 430,000, about there, and now it's down to 410,000. So these are not big moves. Again, median numbers, but you have seen a slight, and a lot of that has to be with affordability. Also, we had a big pull forward of demand in housing during the pandemic. People could move, people shifted around the country. We have the largest domestic migration since the Dust Bowl. So at one time, right, when people were moving, so there's just a lot of things that also went into it. But a big one was it was just really cheap to borrow more house, borrow to buy more house. And that, obviously is dissipated during this time of loan, and that's the affordability issue. And so that also slowed down a little bit building of new homes, right? You actually saw an interesting little world where traditionally existing homes would sell a little bit less than new homes. And that sort of was the flip-flop. And then you'd have a point when existing homes would sell faster than new homes. But also we had this big spike in new homes selling much better than existing homes on the market. And the reason is the developers were trying to find creative ways to buy down that loan, give people a lot of freebie. Oh, we'll give you all your window coverings as part of it. So there was a lot of creativity there to make new homes more affordable than existing homes where people had to go to the bank. And that kind of drove the housing market along. And again, this national numbers. That pull forward of the moving and a lot of this dissipating has slowed down the housing market a bit. It's going to likely pick up in next year, not this year. In next year, it's going to pick up again, but it's not going to be a huge pickup. So if anyone's looking to get into the housing market, selling, buying, investing, etc., on a national scale, you'll see appreciation next year, a pickup, but it won't be this big, surge of demand that will jump forth, assuming inflation and interest rates stay where expected. None of that, by the way, is to tell anybody what they should or shouldn't do with their own individual real estate decisions and purchases. That's best worked on with your financial planner and your realtors to determine what's best for you and your situation. Location has a lot to do with it, and there are other impacts in people's lives that would, cause you to want to buy or sell real estate. So that was just kind of like that high level, but I'm hoping that was going to get the trying to those big questions that we had about the real estate market too. AI's impact on the real estate market, and again, I'm talking, by the way, I should mention, I'm talking residential, I'll mention about commercial. AI's impact is going to be more, are there jobs that you physically need to be present for in places people want to live, and is it driven by AI? Right? That would be potentially part of it. But with the idea that a lot of people can work remotely and how much that's going to be the driver, it's going to be like anything else. People move where there's, if they're young and growing their career where there's opportunity. People are older, maybe they're moving where it's lower cost or near the grandkids or near the family. There's a lot of drivers to where people move. So I would say this is an AI driven at this point, though I have noticed certain markets that are very focused on building data centers and very focused on giving tax benefits to these types of companies coming in. They are growing more quickly right now, so that can have an impact. On the commercial side, the area that's going to struggle the most in some markets more than others, again, location, office space. We're still really overbuilt on office space on a national level. There are some markets, again, where there's still demand, but even in high growth markets, we still are not seeing a lot there. That may pick up in future years, but right now we're not there. So commercial real estate, sort of a mixed bag, same with retail stores and things like that. So for investing in that space, really, really, really be careful, because a lot of these types of investments, commercial real estate traditionally is heavily leveraged, and a lot of these loans are coming due, and you could see some struggling, especially in markets where there's a declining population. So that was hopefully tying to whether that was an investment question or a personal question. Do you expect the Israel deal to affect okay, I think I understand what that says. Do you expect the Israel Hamas deal to impact the markets? Not meaningfully, at least in the near term. Personally, I like the idea we can resolve all the world's conflicts, so it's a positive, most definitely. There's, and I'm getting just in the economics here. So the economics, there's not going to be any real direct impact in the near term. If it holds and if it turns into something more, where maybe you get more development, people feel like comfortable developing more in the Middle East, that region, you could see some economic on a global scale. But to us, it's probably not going to have a big difference. The biggest thing is really just going to be anytime that we can eliminate conflict, it's a good thing for society. So I'll take that as a win. Let's see, questions here. Okay, says, should I invest in crypto? What do you think about the market? Oh boy, I get that question a lot. Here's where the regulators have to be careful. With crypto or any investment, it's an individual answer. Everyone should invest based on their specific situation. There's no one you should invest in or shouldn't invest in. So I just want to put that out there right now. This is not a recommendation to buy or sell crypto or any other type of investment. It is very, very much depends on your tolerance for risk, your understanding of the type of investment, because there's a lot of them out there, and also what else you have going on in your life, right? Your needs and whatnot. So overall, the biggest challenge to crypto is there is no intrinsic value to it. There's nothing backing it except its scarcity, and people want to buy it. So when you have a very little bit of something and a lot of people want to buy it and you can't make more, or you can only make so much of it, it's going to create natural demand. It doesn't matter whether it's tulip bulbs, doesn't matter if beanie babies, doesn't matter if it's crypto. And by the way, I'm not trying to throw crypto into the same bucket as tulip bulbs and beanie babies, but I'm saying that's what creates that demand. There's a lot of argument for it's a currency of the future until it's backed by something that has an intrinsic value that people feel comfortable with the backing. There's a reason the dollar will ebb and flow based on exports and imports and our economic policy and a lot of other factors, but it still is the world's reserve currency, and it's not going anywhere anytime soon. Despite our inability to manage our debt, it is not at risk anytime soon. There is something behind it. The US could sell off its assets and make the bondholders whole, right? We do have actually things backing it, and we have the military power to protect it at this time. So that has an intrinsic value. Other countries' currencies, less so, right? Crypto doesn't have an intrinsic backing. So again, I'm using crypto as a very generic and general term. There are many variations of it with all their own levels of risk, and you really want to make sure you understand it, and are not just investing in it because it's the hot thing or your brother-in-law says it's great. So I hope that answers that one. There was a tie into that, is crypto in a bubble? maybe it's completely unknown. Again, there's nothing backing it. You can't see. Usually when there's a bubble, it's like there's a valuation and there's a price. What is the economic effect of Trump's immigration policy? The answer to that is unknown. The reason it's unknown is this will take time to play out. So I'm taking Trump's economic policy as follows, is people that are undocumented or in the country illegally are being deported. And I think it's, no secret that, there's a number of these people that were working and indirectly contributing to the economy and what that impact would be. I can only say at this point, we don't actually know because we have the guest worker programs where people come into the country to do work, but they're not on a path to become a citizen. They come in each year picking crops and other types of work. So that obviously is underpinning things. That's a legal program. It's been in place for a long time. And then we also, from that standpoint, how far does it go? How far does it go? Does it go beyond, people who didn't come into the country legally? Does it become a bigger issue? Does it disrupt the economy? Disruption's not just because people aren't directly contributing, also could be people maybe not shopping, not spending money. There becomes more of an issue than it is today. So I'm being really careful with this topic because I understand it's very, very political. It's very personal. And I'm just speaking from the economic standpoint is at this point, we don't have enough data. We just have arbitrary opinions. Oh, this situation, but there's no data. You see, this is the first time with tariffs that we actually had some data to talk about. So this is sort of a wait and see situation. And my highest probability is it just depends how far it goes. We have had under previous administrations a similar policy. It wasn't done quite as noisily as it is being done this time, but we have had in previous administrations, we have had a very significant deportation effort towards people that were not in the country legally. This is not the first time. So we just don't know quite how this will play out. Let's see, what happened to our farmers? Yeah, this I kind of talked about this earlier. What will happen to our farmers if China's not buying from us? And like anything else, it depends. I think I kind of explained that pretty well through the soybean story. As long as the farmers have buyers, and most farmers hedge or they have a contract. So if you're a soybean farmer or a corn farmer, anything else that's a commodity, if China backs out of their contract with you and you got all this corn, they have to pay penalties for backing out of the contract. There's a contract, and then you can go sell your corn to Europe. So as long as the demand for it doesn't go away, it's not going to change. And again, it's no different than farmers adapting to a sudden weather event, geopolitical event. This is not unusual, and that's why they hedge. Most farmers will actually hedge against these big fluctuations in price because it's such a risk. You're putting that stuff in the ground. You don't know if there's going to be a drought. So there's most of them again have planned for this and whatnot, but there always will be the exceptions to the rule, and those will be the ones you'll generally hear about in media or social media. Let's see. Is there more risk? Sorry, I'm trying to get back to this one here. Is there more risk to the reduction in regulations? This is a little bit of an open question, so I'll try to answer it. It depends on what regulations and how they're changed, and then what other things are in place. So it's too general to be able to say exactly. I think we can all agree that we have a lot of regulations and a lot of things that are probably unnecessary. Think about it that way. How many times have you actually read that I agree thing that you get from, when you sign up for a new subscription service or something like that? It's all regulations. When you all opened accounts with me, how many of you, I'm sure, I know there are some of you, read the 100 pages that we have to send you. There's a lot of stuff in there that maybe could be streamlined and picked out. So it really depends on what it is, but something to watch for where you can really see there's a bubble is you start to see cuts in regulations and all of a sudden a big expansion in an area. And I'll tell you what I'm watching closely because this one does get the hairs on the back of my neck up a little bit. They passed an allowance now that people can hold private equity and similar investments in retirement accounts. I, for one, think that is a bad idea for 95% of the population because they are high risk. They're not easily understandable for most investors. There are investors that it makes sense for. It's not a be all and end all. The concern I have is that this is people's retirement, their life savings in many cases, And the investment should be very easy to understand and also very liquid and accessible. So there's some things that when I say are less regulations, right? You used to not be able to do that, now you can. There is a risk, but it may not come to pass because the vast majority of people could be like, I'm not buying the thing, I don't even understand what the heck it is. So we'll have to see how that plays out. But all of a sudden we see this big push and a lot of people are investing in this space, then I'm going to say there's going to be some risks there. And that is a regulatory change risk. So it depends on the regulations. It depends what they're doing. Some regulatory changes actually lead to growth and responsible growth, because just because you get rid of regulation doesn't mean it's like the Wild West. There's still oftentimes other things in place. And remember, every administration creates their own regulations, their own rules. The Biden administration created a bunch of rules that the Trump administration is going to change if they haven't already. And the next administration is going to change a whole bunch of rules that the Trump administration put in. So this is an ongoing thing. And it also happens at a state and local level as well. So time will tell if that's going to be an issue. What is low risk outside of CDs? Oh, that's another one. I'm going to kind of punt that and say it depends on your situation and what other investments you have and what your needs are. There are a lot of investments out there that are pretty low risk by historical measures, but every single investment has risk. And I'll be quick with this one. Think of three kinds of risks to be simplistic. There's more, but three to be simple. One, the risk we all think about, losing your money. Okay. You invest $100,000 into XYZ and you lose it. Okay. That's just risk of loss. That usually happens with speculative investments or being forced to sell at the wrong time because you have a need that you didn't plan for. Okay, that's very common, right? How many people sold their homes during the financial crisis because they didn't have enough money to keep it? It's not that they didn't want the house, they just couldn't afford it because they got themselves in over their head. So you want to make absolutely sure in investing that you understand the risks of losing your money, losing it because it was speculative, or losing it because you're forced to sell at a bad time. The other risk is the risk of losing money in what I call the kind of sneaky way, inflation. So if you've got cash, and okay, remember I said official inflation number 2.7%. So if you've got cash lying around or invested lying around that's earning less than 2.7%, technically you're losing money. Now that may be fine. Your checking account, money going in, money going out, that's fine. It's not sitting around long enough to earn enough money that's going to make a difference. But if you've got a big chunk of cash and it's sitting in XYZ bank and they're not paying you an interest rate that exceeds inflation, you are losing money. Your money has lost purchasing power. So using that $100,000 example, your $100,000 today buys a heck of a lot less than it did 5 years ago. So that's something to really be mindful of too. That's a different kind of risk because it's still 100,000, so you feel like your money's safe, but it's not, doesn't have the power it once did. Final one, the one most of us think about, we think about risk, is volatility. Okay, my $100,000 is 80,000, that's 120, and it's kind of bouncing all over the place. The way you manage that risk is you clearly understand the historical norms for any type of investment strategy that you do. You know, or my clients, I like to scare you before you invest because I just want to make absolutely sure, which means we get volatility. You say, I don't really like it, but you told me it would happen. 2/3 of the time, the equity markets are going up, 1/3 they're going down. But when they're going down, it's generally accompanied by horrible, scary news. And also your needs in life can change. What you would accept, you know, 5, 10, 15 years ago may not be what you'd accept when you're close to the time when you need the money. So that answers that question there. But there are quite a number of options that are historically conservative, and that's something you definitely want to talk to our team at Sequoia or someone like us. Ideally, again, not selling a product because you want to be able to look at a few different options there. Oh, fun. Can the president take over the Fed? No. Simple answer. I know we got a lot of headlines and a lot of, you know, fish shaking. You got to cut rates. But no, they can't. There's a reason they're separate. They're separate because one of the biggest reasons that the world does trust our currency, and we are the world's reserve, is the idea that again, for lack of a better term, our monetary system is one and it's separate from politics. Every administration, I remember going back how far, well into the 70s, probably before that, every single administration in the White House has always tried to get the Fed to cut rates. Everyone. They all want it because it stimulates the economy. It makes, you know, looks good, makes their term look good. They're not usually as noisy as the current administration is about it, but it's been done for a while. The Fed, you know, they'll just keep doing what they're doing. The president can, however, appoint the Fed chair. Each administration gets to do it. So the current chair, Chairman Powell, was actually appointed by Trump in his first term, and he was reappointed by Biden. But his term comes up early next year, and he's almost certainly going to be replaced. So as long as the person he's being replaced with is something that the markets and the world has confidence in this person's ability, we'll be just fine. If that's not the case, and you'll hear the media will be blah, 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 this is terrible, this is terrible, this is good, whatever. Ultimately, how you will know is how the market and economy reacts to it, right? That's really what it comes down to. When Trump appointed Powell the first time, that was a change, right? We had a change. And so, it's always a moment the market's like, I'll check you out, make sure we feel comfortable with you. Okay, you seem qualified, you're good, we're good. And then, of course, they'll keep an eye on policy and just to make sure. So anytime a new person comes in, so it's just a moment of seeing how that fits. Besant, the Treasury Secretary, said they're down to about 5 people right now. He's a pretty level-headed guy, and he's actually qualified for his job, and I like him. He's pretty smart about things. So if he's kind of running the show with that and sort of taking the lead on it, that gives a lot more confidence there. But we'll see. It's really going to be important who they are. And again, expect that you're going to hear one side saying it's the worst person ever, and the other side saying best person ever. The markets are going to be the response is going to tell you how good they are, at least in the short term. I'm gonna watch my time here. Let's see if I can get one more in. Sorry. If I don't get your question answered, please reach out to me. I promise I will answer it. I'll just skip that one because I think that will be good to save for next time. But I know who you are, and I will just send you an answer. Let's see. The risk. Okay. The risk of the economy is basically the risk of the economy in relation to Washington's policies, question mark. So that one is a long conversation, so I'm not quite sure, which direction to go with that. Any policy that's put in place by any administration is going to have winners and losers. There's no way around that. Even if you could say, it's the cure for everything, right? There'll be losers, right? Some company that had the cure before is out of business. There's not going to be any policy in any administration that's all going to be for the win. Oftentimes people tend to attach to, again, their belief system. Okay, this is good because my side likes it. This is bad. It's not really that simple. There will be winners and losers and everything. There's a lot of challenges, and the biggest challenge we have as a nation is how do we support our people, not to the degree they become dependents of the state, unless, of course, there's disability, there's a true reason for it, that they become dependent at the same level that we support the people that have the most need, but also don't run our country off a cliff with the debt levels that we're accruing. And it's a really, really challenging thing to do because it costs a lot of money to give people everything they want. Whether it's lower taxes or it is more social benefits, it costs a lot of money. And the combination is going to be, over time, a balance of that. You can raise taxes a bit. You can't tax everybody very high amounts of money because it will kill productivity, and productivity is what feeds the system. The government makes more money from the bulk of the population, not from the top and not from the bottom, just because of percentages, not because they're paying. Obviously, the 1% pays more in taxes as a percentage, right, than most of the population. You can increase taxes to a degree, and you can cut back on some programs and balance things out. And it takes a lot of work, and it takes that political will and political expediency. And in the environment we're in right now, it's really hard to get consensus on things. This becomes more challenging. I've spoken about before, we have until about the 2030s based on math to figure this out. So my highest hope is that we can find leaders, and we can also, as citizens of the country, find ways to work together to solve some of these issues and not have a winner take all mentality. So fingers crossed that we can get the kind of people to do that, but it all starts with us, to accept the fact that we can't have it all. The debt levels are going to be an issue for our nation, and they'll be a big issue, and you guys only watch. Time, I like to be respectful in keeping this to an hour. I thank you very, very much for listening.